Avoid these 5 biggest investing mistakes. They could cost you over $100,000. Don't let your hard-earned money just disappear. Learn how to invest smarter today.
What if I told you the biggest threat to your money isn't a stock market crash? It's you. More specifically, it's 5 quiet psychological traps that most of us fall into. You see, most investors don't lose $100,000 in one spectacular bad bet. They bleed it out slowly through a handful of emotional habits that compound over time. We're going to break down the 5 most expensive ones and, more importantly, how to stop them from draining your wealth. 5 investing mistakes costing you $100,000. Our own minds are quite often our worst enemies when it comes to building wealth. We are basically walking around with these caveman brains, entirely hardwired for survival in the wilderness, and yet here we are trying to navigate complex, modern financial markets. It's human nature, our instinct to flee from danger or just instinctively run towards the herd, that actually becomes this invisible enemy quietly draining our wealth over decades. But by shining a light on these 5 specific traps, we can completely rewrite our financial futures. Okay, let's dive into this with trap number 1, the timing illusion. Now, this trap is that incredibly tempting but totally foolish belief that you can somehow outsmart the market. Perfectly time your exit, sell exactly at the peak, and then magically swoop right back in at the absolute bottom. But timing the market? It's a fool's errand. It's a strategy driven by stress, pure guesswork, and usually entirely missing the mark. Instead, your true superpower is time in the market. Sure, day to day, the market is incredibly unpredictable, but historically, it trends upward over the long haul. The longer you simply leave your money invested and let it do its thing, the better off you're going to be. To put some real perspective on this, consider this stark reality. Missing just a handful of the market's best days can absolutely crush your long-term returns. Depending on the size of your portfolio, sitting on the sidelines in cash and missing just the 10 best days in the market over a couple of decades could easily cost you 6 figures in gains. 10 days, literally 10 days out of decades of trading. If you try to jump in and out, you risk missing those massive, totally unexpected up days that do all the heavy lifting for your wealth. The fix is simple, even if it's not always easy. Just stay put. Trap number 2, the panic button. Market drops are a completely normal part of the investing ride, but when things get rocky and your portfolio flashes red, our caveman brains literally scream danger at us. It triggers this gut-wrenching urge to just panic sell everything. We need a massive paradigm shift here. When your portfolio drops in value during a downturn, it is just a paper loss. Ground yourself in the cold, hard logic. You haven't actually lost any physical money yet. It's purely a temporary drop in value. It only becomes a permanent, locked-in, very real loss if you give in to that fear and hit the sell button. If you just hold steady, you still own the exact same number of shares. You're just waiting for their value to bounce back. So how do we fight this primal fear? Well, you absolutely must have a written plan established way before the panic even sets in. When the market is crashing, your emotions are going to be screaming at you to jump ship. You literally cannot trust your own brain in that moment. That logical, cool-headed, written plan that you created on a calm, sunny day, that is your absolute best defense. It acts as an anchor when the emotional storm inevitably hits. Trap number 3, the herd mentality, or as we all know it, FOMO. This one is driven entirely by the fear of missing out. It's that nagging little voice whispering in your ear that everyone else is getting rich while you are sitting there getting left behind. And this brilliantly illustrates the life cycle of a hype investment. It's so predictable. Early investors buy in quietly in month 1. By month 3, it's trending all over social media. By month 5, you're hearing your uncle pitch this can't-miss stock at a family barbecue. But notice what happens next? Month 6 is almost always the crash. Following the herd usually just means you're buying high right as those early investors are cashing out using your money. The real solution to FOMO is discipline. You have got to learn to ruthlessly ignore the noise. The goal here is to build a diversified portfolio that actually matches your own personal long-term financial goals. Your portfolio shouldn't be based on whatever happens to be trending on social media this week. Let the herd run right off the cliff. You just stay on your carefully plotted path. Trap number 4, the silent wealth drain. Now let's slow things down for a second because this trap isn't dramatic. In fact, it's incredibly boring. But ignoring the little fees and taxes that constantly nibble away at your returns is just incredibly destructive. A 1 or 2% management fee, it sounds tiny, right? Barely a rounding error. But when you apply that seemingly tiny fee over 30 years on a decent-sized portfolio, the math gets scary. That 1 to 2% compounds to literally eat hundreds of thousands of dollars in lost wealth, money that goes straight into someone else's pocket. Plus, frequent trading triggers taxes, which acts as another constant, heavy drag on your portfolio's engine. So the crucial point is how we stop this constant drain. The absolute best strategy is to favor low-cost index funds and ETFs. These vehicles give you broad exposure to the market without that massive management price tag attached. But even more importantly, you need to think like a long-term owner, not a short-term trader. The less you trade, the fewer taxes you trigger, and the more of your money actually stays in your account to grow. Trap number 5, the overconfidence illusion. This is a really sneaky one. Mostly because it strikes right when you think you have everything figured out. It creeps up on you after a great winning streak, or maybe right after crossing a major milestone, like hitting your first $100,000. You feel brilliant, you get a little too cocky, and overconfidence totally tricks you into thinking you've cracked the code. And that's exactly when investors abandon the solid, boring strategy that got them there in the first place. Because they think they've already won, they start making highly destructive errors, taking on way too much risk, betting big on single companies, or worse, just stopping their contributions altogether because they assume their money will magically multiply on its own. Always remember this. In investing, discipline is often far more valuable than genius. Wealth building really isn't about being the smartest person in the room. It's not about having some secret algorithm or predicting the future. It is entirely about consistency. The boring, steady investor will almost always outperform the erratic genius over a 30-year timeline. Defeating the invisible enemy. Avoiding those 5 traps, the timing illusion, the panic button, the herd mentality, the silent wealth drain, and the overconfidence illusion, actually has very little to do with being a stock market wizard. It is ultimately about mastering your own psychology. Let's move to and see how this builds into your ultimate actionable strategy. Step 1, set clear long-term goals so you know exactly why you're investing. Step 2, automate your investments. Make it so money just transfers into low-cost index funds every single month without you having to make a choice. And step 3, ignore the noise. Turn off the financial news, stop checking your portfolio every single day, and just let the market do its job. The real secret to building wealth isn't a complex equation. It's discipline, patience, and consistency. By focusing on the decades, not the days, you can protect your portfolio from its own worst enemy, which is you. So I leave you with this provocative question to ponder. Will you let your emotions cost you your next $100,000, or will you choose discipline today? If you found this explainer helpful and want to really master your wealth-building journey, make sure to hit that subscribe button for more insights. Stay focused, and we'll see you next time. Welcome to this explainer. Today, we're unraveling one of the absolute most fascinating and, honestly, frustrating mysteries in the entire world of personal finance. We're looking at something I like to call the investor paradox. History shows us that over long periods, the stock market relentlessly builds wealth. It just does. Yet, despite having this incredible wealth-generating machine right at our fingertips, everyday investors consistently fail to capture those historical market highs. So why is it that an engine designed to build wealth so often leaves the average person falling behind? Okay, let's dive into this massive contradiction. It is literally the ultimate puzzle. You have the market on one side, trending upwards over decades, and on the other side you have the average investor's personal wealth, which often tells a completely different, much more disappointing story. And we aren't just talking about a few bad stock picks here. No, we're talking about a structural, widespread failure to capture what should be easily attainable market returns. To figure out why this happens, here's our roadmap for today. We'll start with the investor performance gap, then move into the psychology of losing, and follow that up with the Gen Z FOMO factor. After that, we'll break down the cold, hard math of investing, and finally, we'll wrap up with mastering disciplined behavior. All right, part 1, the investor performance gap. Before we can even try to solve this problem, we need to understand exactly how much money the average investor is actually leaving on the table. Embrace yourself, because this number from the 2021 Dalbaugh report is staggering, 1,000 basis points. In plain English, that's a full 10% gap. This represents the massive chasm between the performance of the average equity fund investor and the S&P 500 during that year. Think about that for a second. The market does the heavy lifting, but through a series of behavioral missteps, average investors manage to underperform the benchmark by a full 10%. And hey, this isn't just some one-off fluke. As you'll see here, there is a consistent sea of blue underperformance bars dropping below the zero line, stretching all the way from 1985 to 2021. Every single one of those blue bars represents a year where the average equity fund investor lost to the market. It's wild, but it visually proves that humans are structurally terrible at capturing market returns over the long haul.
So if you're wondering how we mess this up so consistently, it really comes down to our terrible ability to time the market. Take a look at what Delbar calls the guess-right ratio. It measures how often investors correctly anticipate the direction of the market based on their mutual fund inflows and outflows. Notice how frequently those bars are sitting well below the 50% mark. In a lot of years, you'd literally have better odds just flipping a coin. Our intuition on when to buy and sell is often dead wrong. So the natural question is, why? Why is our intuition so incredibly bad?
Which brings us to Section 2, the psychology of losing. The absolute biggest culprit here is a concept from behavioral economics known as loss aversion. Basically, it's a cognitive bias where the sheer pain we feel from losing money is perceived as roughly twice as severe as the satisfaction we'd get from gaining that exact same amount. This creates what researchers call the hot stove effect. Think about a cat that jumps on a hot stove. It's never going to jump on a stove again, even a cold one. Investors are exactly the same. When they get burned by a market drop, they pull their money out purely out of fear, and they end up completely missing the eventual recovery. This whole idea is rooted perfectly in this quote from Nobel Prize-winning psychologist Daniel Kahneman. The response to losses is stronger than the response to corresponding gains. Honestly, if you've ever felt that sheer panic during a market dip and just sold off your investments, this science totally validates your struggles. It is quite literally human nature to panic. Our brains are hardwired for survival, right? Not for optimal long-term portfolio management. But what happens when you take that ancient, hardwired psychology and toss it into the modern digital age? Let's look at Section 3, the Gen Z FOMO factor. A recent study on Generation Z investors revealed a massive information paradox. Despite having the entire internet right in their pockets, younger investors are leaning heavily on low-credibility sources, think flashy financial influencers and pure success stories on TikTok, rather than boring but highly credible sources like official company reports or actual financial literacy data. Why is that? Well, it's FOMO, the fear of missing out. Seeing your peers brag about massive crypto or stock gains online acts as this incredibly powerful emotional trigger. It completely overrides rational decision-making and drives impulsive, highly risky choices, just to avoid feeling left behind. Let's move to and see how this builds. Section 4, the math of investing. Now, even if you manage to conquer your emotions and totally ignore the FOMO, you still have to contend with the cold, hard arithmetic of the financial industry. We have to talk about active management versus passive indexing. Back in 1991, Nobel laureate William F. Sharpe presented an elementary mathematical proof that changed everything. He pointed out that, by definition, the market is just the sum of all active and passive investors. Therefore, before costs are factored in, the return on the average actively managed dollar has to perfectly equal the return on the average passively managed dollar. It's a mathematical certainty. But here is where the simple laws of subtraction guarantee a massive problem for active managers. After costs, active returns absolutely must be lower than passive returns. Why? Because active managers have to eat. When you use them, you're paying for extensive research, way higher trading volumes, hefty salaries for analysts and brokers, and expense ratios that generally run between 1.0 and 2.5%. A passive index fund, on the other hand, basically just sits there and costs next to nothing. Subtraction literally guarantees that the more expensive active strategy will, on average, underperform the passive one. And this brilliantly illustrates why those fees matter so much. You might look at this and think, hey, a 1% expense ratio, that's tiny, who cares? But look at the impact of compounding over time. Over 10 years, a 1% fee eats up about 7% of your potential wealth. Fast forward 40 years, which, by the way, is a completely normal horizon for a young investor saving for retirement, and that seemingly tiny 1% fee will silently devour 25% of your final wealth. That's a quarter of your money. Gone. Not to the market, but to the lost compound interest on those fees. Finally, let's wrap up with Section 5, mastering disciplined behavior. So, what does this all mean and how do we fix it? Well, beating the market isn't about outsmarting Wall Street with hot stock picks. It's almost entirely about overriding your own bad habits and setting up systems that protect you from yourself. Just like this insight from MFS beautifully summarizes, moving in and out of the market timing, to avoid volatility rarely works. Long-term success actually requires ignoring the noise entirely. You just have to accept that doubt and volatility are the price of admission to the market. You can't time the tops, and you certainly cannot time the bottoms. To actually put this into practice, wealth managers swear by 3 strict, actionable rules that act as a behavioral shield against things like loss aversion and FOMO. First, schedule ongoing automatic deposits. Literally just automate it. This totally removes the emotional burden of deciding when to buy. Second, commit right now to a predetermined dollar amount you'll add during market dips. That turns your fear into a mechanical, almost robotic action. And third, stop unnecessarily checking your account. Staring at your portfolio every day only triggers that loss aversion we talked about. Doing these 3 things proves that investor psychology is often a way more significant determinant of your wealth than the actual assets you're buying. I want to leave you with this final provocative thought to chew on. Take a real, honest look at your own financial habits. Are you letting your hardwired psychology, the fear, the FOMO, the sudden urge to tinker, dictate your wealth? Or are you finally ready to step back, automate your discipline, and let the undeniable math of the market work for you? At the end of the day, conquering your own mind really is the ultimate secret to financial growth. Thanks for joining me on this explainer, and I really hope this gives you a completely fresh perspective on your portfolio.
Mistake number 1, the illusion of timing the market. Okay, let's jump right into this explainer. First up is the absolute classic, the ultimate temptation for anyone trying to build long-term wealth. You see financial storms brewing and you think, hey, I can outsmart this. I can creatively navigate my way around the turbulence. Today, we're breaking down decades of data to look closely at what is widely considered the biggest mistake investors make, the sheer illusion that you can successfully time the market.
I mean, it's a super compelling fantasy, right? We all kind of want to believe we have this magic touch to dodge the drops and ride the rockets. The idea seems simple enough. Just sell your assets right before the market crashes, wait safely on the sidelines, and then magically swoop back in to buy everything at rock-bottom prices just as the recovery kicks off. Sounds like the perfect strategy. But let's see what the data actually says about our instincts and our supposed ability to predict the future.
So, legendary investor Peter Lynch, the guy who managed the Magellan Fund through some crazy volatile times, he made this really profound observation. He said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. Seriously, think about that for a second. The very act of bracing for impact, of trying to duck and cover from a market downturn, actually destroys way more wealth than if you had just taken the hit and stayed the course.
Because here's the thing, most people think inaction is the risky move during volatile times, but we are going to completely flip that script right now. According to the research we're analyzing today, the greatest risk to your financial plan usually announces itself way too late, when recovery isn't even possible anymore. And here is the brutal truth. The markets rarely cause this failure. The true hazard is what researchers call the behavior gap. It's our own response to the market, chasing whatever's hot, fleeing temporarily fallen categories, or just completely abandoning our strategies during distress. That is exactly what converts a temporary market decline into a permanent derailment of your wealth.
Let's look at Dalbar's 2025 quantitative analysis, which is one of the most comprehensive annual studies on investor behavior out there. It puts this problem into stark, undeniable numbers. In 2024, the S&P 500 returned a phenomenal 25.05%. To get that return, literally all an investor had to do was absolutely nothing. Just sit there. But the average equity investor, they earned just 16.54%. That is a devastating gap of almost 8.5% in a single year. And it was driven entirely by behavioral errors, selling before rallies, panicking over sensationalized headlines, and jumping back into the market way too late.
Now, missing out on 8.5% in 1 year is bad enough, but zooming out shows us the true catastrophe here. When you compound that behavior gap over a 20-year period, it becomes absolutely staggering. Check this out. A hypothetical $100,000 left completely untouched in the S&P 500 for 2 decades grew to over $717,000. But the average active investor, constantly tinkering, trying to time those perfect entries and exits, they finished with just about $345,000. They literally lost over half their potential wealth. That's a massive gap of over $371,000. And let's be absolutely clear, the market didn't take that money. The investor actively traded it away.
I know. It is incredibly hard to stand still in a sea of panicking umbrellas.
When uncertainty hits and up to the second data is flashing bright red all over your screens, the urge to do something feels like the responsible move. But reacting to those headlines and trying to time your entry and exit points, it's the ultimate wealth destroyer. The financial media loves to sensationalize events, to invite action, but acting on these totally unknowable and uncontrollable variables, like short-term economic forecasts, it practically guarantees you're going to sabotage your own ability to compound wealth.
Think about it. When investors decide to pull their money out of equities and return, when the environment improves, they are playing a wildly dangerous game of musical chairs. And the penalty for losing this game is insanely steep, because the environment is virtually impossible to call. So what actually happens to your wealth if your timing is off by just a tiny fraction, and you happen to miss just a handful of the market's absolute best performing days while you're sitting safely in cash?
Well, this staggering data from JP Morgan covering 20 years, which is roughly 5,040 trading days, makes the math undeniable. If you simply stayed fully invested for all 5,000 plus days, your annualized return was 10.5%. But if you missed just the 10 best days out of those 2 entire decades, your return collapsed down to 6.2%. Miss the 30 best days, you're down to an anemic 1.4%. And if your market timing experiments caused you to miss the 50 best days over a 20-year span, your returns actually turned negative. No joke. Depending on your portfolio size, being on the sidelines for just those 10 best days over a couple of decades could easily cost you 6 figures in gains.
But here is the absolute kicker: understanding exactly when those best days happen. Let me tell you, they do not happen when skies are perfectly clear and the news is exclusively positive. No way. According to the data, 7 of the 10 best days in the market fell within 15 days of the 10 worst days. They happen during periods of maximum pessimism and extreme, stomach-churning volatility, which means that trying to avoid the storms by selling out mathematically guarantees you are going to miss the rapid, massive recoveries that almost immediately follow them.
And hey, if you need more proof, let's look at some rigorous academic research out of the Berkeley Haas faculty. They reviewed the investment performance of individual investors and came to a very blunt conclusion. Trading is hazardous to your wealth. Basically, by analyzing individual accounts and comparing their active trading returns to what they would have earned if they had just held their beginning-of-year portfolios, the researchers proved that the net return performance of active individual investors is reliably, consistently negative. The academics actually found a few fascinating behavioral traps we fall into. First off, individuals tend to mistakenly hold on to losers and sell winners, wrongly expecting those losers to somehow bounce back and outperform in the future. Second, they tilt towards stocks that have recently performed poorly. And finally, the very act of trading frequently, executing small trades, eating commission costs, it results in returns that lag a simple value-weighted market index by over 5% annually. And for high-turnover households, people who are trading constantly, the underperformance averages a staggering 10.3% every single year.
So, the fix to all this financial devastation is simple in theory, but as you can imagine, it requires immense emotional discipline in practice. It requires stepping away from the crowd. It demands independent thinking and the pure fortitude to stand out from the herd and do absolutely nothing when everyone else around you is frantically buying or selling. Like the research notes, building long-term wealth demands counter-emotional decisions. You have to refuse the euphoria of a hot market and hold firm during maximum pessimism.
Early 20th century speculator Jesse Livermore captured the essence of this perfectly. He noticed that ordinary investors don't fail because the market beats them. He said they beat themselves because, though they have brains, they cannot sit tight. And that pretty much anchors our entire reality check for this explainer today. The market isn't your biggest enemy in long-term wealth generation. Your own inability to sit tight, ignore the noise, and just remain patient, that's the real enemy.
So, what you should take away from this is a fundamental shift in how you view market participation. Timing the market relies on continuous action and emotional reactions to news. And as we've seen from Dalbar, JP Morgan, and Berkeley Haas, that reliably leads to severe underperformance. On the flip side, time in the market requires patience, emotional discipline, and a willingness to endure the inevitable short-term dips. Time in the market is your absolute superpower, whereas trying to time the market is a verified fool's errand.
Ultimately, it all comes down to mastering your own behavior. Knowing that equities have historically rewarded patient investors more reliably than any other asset class gives you permission to do nothing, precisely at the moments when everyone else feels they just have to do something. So I'll leave you with his final provocative thought to review your own portfolio and strategy with. When the next volatile market swing happens, and it for sure will happen, will you have the discipline to be investing for the long run, or will you let your emotions tempt you into trading your future wealth away?
Okay, let's dive right into this explainer by asking a really simple but honestly incredibly frustrating question. Why does our natural primal survival instinct desperately want to sabotage our life savings? Seriously. Welcome everyone. Today we're exploring one of the absolute most destructive forces in personal finance. Mistake number 2, panic selling in a downturn. Look, market drops are a completely normal part of the ride, but today we're going to break down the exact biological and mathematical reasons why dumping your stocks the second things get rocky is, for sure, the quickest way to lock in a permanent loss.
Benjamin Graham, the legendary father of value investing, he actually hit the nail right on the head regarding our biggest obstacle. He basically said that if you can't master your emotions, you are ill-suited to profit from investing. It's that simple. We are up against this massive, invisible psychological battle the minute the market turns red. It is a literal street fight between pure, gut-wrenching fear and cold, hard logic. And listen, if you can't master that emotional side, all the investing mechanics in the world just aren't going to save you.
All right, let's jump into concept number 1, the caveman brain trap. So, let's look at how our own biology fundamentally clashes with modern financial markets. For hundreds of thousands of years, we evolved to react instantly to sudden threats, right? A tiger jumps out of the bushes, your caveman brain screams, "Danger!" and you run. It kept us alive. But today, that exact same primal alarm bell goes off when you check your 401k on your phone and see a 20% drop. The problem? Well, running away from a market drop is basically the financial equivalent of running directly into the tiger's mouth. Think of it this way. It's only a temporary paper loss until you sell. The value fluctuated, sure, but you still own the exact same number of shares. The very second you give in to that fear and hit the sell button, bam, you've just converted a temporary dip into a permanent, realized loss.
Moving right along to concept 2, the true cost of panic.
We all know the urge to jump ship is totally natural. But to really understand why acting on that urge is so insanely dangerous, we have to look at the undeniable math behind market timing. Based on JP Morgan's analysis of a 20-year period, there were roughly 5,040 trading days. To put that into perspective, if an investor simply stayed fully invested through everything, the ups, downs, crashes, panics, they saw an annualized return of 10.5%. But what if you tried to time it? What if you pulled your money out to wait for things to, quote-unquote, calm down, and you ended up missing just the 10 best days out of over 5,000? Your return basically collapses to 6.2%. Miss just 30 days? Your return plummets to a barely visible 1.4%. Now, you might be thinking, okay, I'll just pull my cash out on the really bad days and put it back in for the good days, right? Makes sense. But here is the absolute fatal flaw in that plan. 7 of the 10 best days in the market fell within precisely 15 days of the 10 worst days. This right here perfectly illustrates the catch-22 of panic selling. Those explosive wealth-generating recoveries, they almost always happen immediately after the most agonizing market storms. So trying to avoid the pain virtually guarantees you're going to miss the massive gains that follow. Okay, concept 3, mind the behavior gap. This constant instinct to flee from bad headlines creates a very real, measurable phenomenon. Research from Dalbar tracking over 20 years of data shows something fascinating. While the average U.S. equity fund returned a super healthy 10.35% per year, the actual human beings investing in those exact same funds only earned 9.24%. That gap, that 1.11% annual difference, is literally the price tag for poor timing decisions. Driven by fear, investors end up acting completely contrary to their long-term plans. They constantly buy high and sell low, and honestly, over a lifetime of compounding, losing over 1% annually, that wipes out a staggering amount of potential wealth. Which brings us to concept 4. Volatility is the engine. To stop this wealth destruction and actually close that behavior gap, we have to completely reframe how we view market drops. The financial industry and the daily news love to mislabel volatility as this terrifying enemy. But as research from Wells Fargo Advisors points out, volatility is absolutely certain. Without exception, the market has always recovered and made new highs. Think about a surfer navigating a massive wave. The wave is turbulent, it's powerful, and yeah, it's dangerous if you panic. But for the surfer, that turbulence isn't the enemy. It's the very energy propelling them forward. Volatility is not something to hide from. It is literally the fundamental mechanism of wealth creation. There's a great saying for this. Absent volatility, there is no return. It really is that simple. If the market were this perfectly flat, safe, completely predictable line, well, it would pay out exactly like a savings account.
Investors earn outsized returns precisely because they are willing to hold their capital through the gut-wrenching, terrifying uncertainty that everyone else just can't stomach. The premium you earn in the stock market, think of it as hazard pay. You're getting paid for keeping your seatbelt fastened while everyone else is screaming and scrambling for the exits.
Finally, Concept 5, your pre-written defense plan.
So, if fear is a completely natural biological response, but mathematically devastating to our portfolios, how do we actually protect ourselves? Vanguard research highlights the absolute necessity of having what they call an emotional circuit breaker. When your caveman brain is screaming that the sky is falling, an advisor, or even a rigidly enforced personal rulebook, acts as that circuit breaker. It steps in to short-circuit your natural tendency to run for cover. A single, well-timed intervention during a market panic can prevent catastrophic wealth destruction simply by forcing you to stick to the plan. So what does a cool-headed defense plan actually look like? First, and this is absolutely crucial, you must have a plan written down before the panic sets in. That logical, calm plan is your best defense when your emotions are suddenly telling you to jump ship. Second, structure your assets so your near-term life is totally funded by cash and reliable income. If you know exactly how you're paying for groceries for the next couple of years, your long-term capital actually has the time it needs to recover. And third, once that safety net is in place, a 30% market drop is no longer a crisis. Actually, scratch that. It becomes a massive buying opportunity. You shift from total panic to capitalized action. Which brings us to the ultimate takeaway of this explainer. I want to leave you with this final thought to consider for your own life savings. Next time the inevitable market storm hits, the screens are bleeding red, and every single headline is screaming danger, what's going to guide your hand? Will you surrender to your caveman brain, locking in a permanent loss just because hitting sell feels safe in the moment? Or will you rely on the unshakable logic of a pre-written plan, knowing that this temporary turbulence is the exact engine driving your future wealth? The choice is entirely yours. Keep learning, stay focused, and I'll see you in the next explainer.
Welcome to The Explainer. Today, we're jumping right into the third major investing mistake we see people make over and over again. We're talking about the FOMO trap and that incredibly destructive habit of chasing hot stocks. Let's get right into it.
To really wrap our heads around why we fall into this trap, we kind of have to look in the mirror. Benjamin Graham, who's basically the father of value investing, hit the nail on the head when he said, "The investor's chief problem, and even his worst enemy, is likely to be himself." It's an uncomfortable truth, right? But in behavioral finance, we have to acknowledge that the biggest threat to your portfolio isn't the Federal Reserve, it's not inflation, and it's definitely not market volatility. Honestly, it's your own psychology.
And a massive part of that psychological threat comes down to herd mentality. It's a very well-documented cognitive bias. Basically, it's a visceral, almost biological urge to just do whatever the crowd is doing. We've all heard that little voice that whispers, "Everyone's getting rich off that one hot stock, and you're not." When you hear your neighbor or a coworker bragging about getting rich early on some trending asset, it triggers a very real psychological response. You feel this intense fear of missing out. Suddenly, logic goes completely out the window, and you feel compelled to jump on the bandwagon just because everyone else is.
Now, when that herd mentality takes over the broader market, we see what economics professor Burton Malkiel calls the greater fool theory in action. People start buying up assets without even caring about their actual underlying value. They're just assuming they can sell it later to a greater fool at a higher price. The crowd literally draws more of the crowd. But here's the real tragedy of this whole cycle. The retail investors who jump in purely out of FOMO, they usually end up being the greatest fools of all. Because by the time you're hearing about a can't-miss investment at a family barbecue, the party's probably winding down. This herd mentality usually leads to buying high, right as the early investors are quietly cashing out and heading for the exits.
But, it's not just fear that derails us. It's also arrogance. And that brings us to overconfidence bias. This happens when we inaccurately perceive our own abilities and the limits of our knowledge. Imagine you buy a hot stock on a total whim, and it actually goes up. Well, it's incredibly easy to trick yourself into thinking that luck was actually your own sheer brilliance. Behavioral finance studies show that as investors get a little experience and a couple of quick wins, they start overestimating their skills. They brush off crucial advice, they completely ignore historical data, and they start trading excessively, taking on risks they don't even begin to understand.
So this brings up a pretty tough question you have to ask yourself. Are you trading for entertainment, or are you actually investing for wealth creation? Because the research is crystal clear on this. Frequent trading is hazardous to your wealth. Academic studies suggest that some people trade simply because they genuinely enjoy the thrill of it. They love that dopamine hit of a fast-moving market, even if, subconsciously, they know it's probably hurting their future wealth. But if your actual goal is to build a secure financial future, treating the stock market like a casino is pretty much a guaranteed way to sabotage yourself.
Which leads us to the ultimate risk. When we talk about risk, most people immediately picture stock market crashes or seeing their account balance temporarily dip. But the true ultimate risk? It's failing to reach your long-term goals. It's hitting retirement age and realizing the money just isn't there. That is a devastating failure because it usually announces itself way too late to actually fix it. It's the kind of failure that cannot be undone. And the hardest truth to swallow is that the markets rarely causes permanent derailment. The investor's emotional response to the market does.
I want to show you some hard data on this from Dalbar's 2025 Quantitative Analysis of Investor Behavior. In 2024, the S&P 500 had a fantastic year, returning 25.05%, but the average equity investor, they only earned 16.54%. That is a massive 848 basis point gap in just a single year. And here's the kicker. Capturing that higher 25% return required zero action. Literally, you just had to sit on your hands. The average investor lost out on that extra gain precisely because they were busy doing things, trading, reacting, and trying to outsmart a market they really should have just been participating in.
Now, let's zoom out and look at the staggering cost of this over a much longer timeline. Say you took a hypothetical $100,000 and left it entirely untouched in the S&P 500 for 2 decades. It grew to $717,503. But the average investor, making those typical behavioral errors, selling before rallies, panicking at news headlines, trying to time the market, finished that exact same 20-year period with just $345,614. That is less than half the wealth, surrendered simply because they lacked emotional discipline.
$345,614. Just let that number sit with you for a second. That is hundreds of thousands of dollars in lost compounding potential. And remember, the market didn't steal that missing money. The economy didn't take it away. The investors' own emotional, fear-driven, FOMO-induced decisions systematically destroyed it.
So, how do you fix it? How do we stop the bleeding? Well, if we look at the principles from Elevation Capital, the absolute first rule of long-term investing is to avoid self-destructive behavior. Like Benjamin Graham reminded us earlier, if you can't master your emotions, you're ill-suited to profit from investing. Building wealth means having the discipline to do the exact opposite of what your instincts are screaming at you to do. You have to buy low and sell high, not panic and sell everything the minute things look grim.
To actually avoid self-destruction, we need to recognize exactly what it looks like. It's selling right before the market rallies because the pain of a dip just feels like too much. It's re-entering the market way too late and missing the best part of the recovery. It's reacting impulsively to sensational headlines, or ditching your carefully crafted strategy the second volatility hits. It's chasing hot stocks or managers after they've already peaked and fleeing categories right when they're historically cheap. Every single one of these actions is driven by emotion instead of data.
The real antidote to all this chaos is independent thinking. Independent thinking is absolutely essential for long-term success. It means having the immense discipline to stand apart from the crowd, to be that one white umbrella in a sea of black ones. It means being completely willing to buy the very things other people are desperately trying to sell, and selling the assets that everyone else is clamoring to buy. It feels incredibly uncomfortable in the moment, but in financial markets, blindly following the herd usually leads you right off a cliff. Research from Vanguard shows that the best way to maintain this independent mindset is to have a well-thought-out plan, backed up by behavioral coaching. Think about it. The daily noise of social media, financial news, water cooler talk, it's deafening, and almost none of it actually pertains to your specific long-term goals. A solid plan acts as your anchor, and having an advisor, or even just a very strict set of personal rules, acts as your behavioral coaching. It helps you cut through all that noise and resist the urge to make drastic changes just because everyone else is panicking or partying on whatever is trending on social media this week. So, Vanguard recommends a highly effective, structural solution for managing these psychological flaws. They call it the core and satellite approach. Step 1. Build a broadly diversified, low-cost core portfolio that matches your long-term goals. This is the boring engine that actually drives your wealth. Step 2. If you absolutely must scratch that itch to trade, limit your satellite allocations to small, safe levels. Basically, create a strict containment zone for your speculative urges. And step 3, which is absolutely the most important, stick to this plan strictly during periods of market distress.
When the market drops, you rely on the structure you built, not your gut instinct.
Now, that core portfolio relies heavily on Principle V6, spreading your investments. You've probably heard diversification called the only free lunch in investing, and it's true. While the daily news focuses almost entirely on the excitement of the stock market, truly great investors spread their wealth across major categories: equities, fixed income, property. They accept the reality that no single asset class is always going to be the favorite. Diversification smooths out your returns over time, but more importantly, it smooths out your emotional experience, making it so much easier to just hold on during the rough patches.
This kind of discipline ties directly into Principle 7, disregarding short-term forecasts. When things get uncertain, it is so tempting to look to the experts to tell us what's going to happen next. Don't do it. As the economist John Kenneth Galbraith used to joke, the only function of economic forecasting is to make astrology look respectable. Seriously, there was a study that looked at expert interest rate forecasts from the Wall Street Journal over 26 years. The economists were wrong on the direction of rates 67% of the time. Their predictions were statistically indistinguishable from just flipping a coin. So save your energy and stop stressing over unknowable short-term predictions.
So, here is your long-term fix to the FOMO trap, all put together. First, you have to accept that short-term underperformance is just inevitable. Second, stop trying to time the market. Third, be relentlessly patient. Time is the great corrector in investing. And finally, rely on strict discipline rather than whatever exciting narrative is driving the herd today. Which brings us right back to that final, critical question you have to answer for yourself. Are you genuinely investing to achieve your long-term goals, or are you just trading for entertainment? If it's entertainment, you need to acknowledge the massive cost of that ticket. But if you're actually trying to build wealth, it's time to build a diversified portfolio, put your blinders on, and ignore the noise. Because the math is undeniably clear. The absolute most profitable thing you can do in a panicked or euphoric market is to do absolutely nothing. Thanks for joining me on this explainer. Keep your head, stick to your plan, and we'll catch you next time.
What if I told you there is a massive, six-figure investing mistake just lurking quietly in your retirement accounts right now? Well, welcome to our latest explainer. Today we're breaking down a really critical piece of research on the 5 investing mistakes that cost people hundreds of thousands of dollars. But instead of looking at the loud, dramatic errors, we're going to focus on the silent killer, the one you probably aren't even thinking about. Okay, let's dive into this. When I ask people, what is the biggest threat to your money, their minds immediately go to the absolute catastrophic. They picture a massive stock market crash. They imagine news anchors panicking, red tickers flashing across the screen, and their entire life savings just evaporating overnight. And it makes sense, right? We're conditioned by our caveman brains to look for loud, obvious dangers. But that assumption is completely wrong. The reality? The real threat actually isn't what happens on Wall Street at all. It's what happens in your own head. You see, people rarely lose a massive amount of wealth in one spectacular theatrical bad bet. You aren't just going to wake up one day and accidentally dump your entire life savings into a bankrupt company. Instead, investors bleed out their wealth slowly. They lose it through a handful of emotional habits and psychological traps they don't even realize they've fallen into. And the stakes here are absolutely massive. We are not talking about losing out on the cost of a few cups of coffee. Because of how compounding works, falling into these really subtle psychological traps can easily drain $100,000, or honestly, even more, from your potential wealth over a couple of decades. I mean, that is life-changing money. That's an early retirement, a paid-off mortgage, or a college fund for your kids, just vanishing because of completely avoidable mistakes. Section 1. The silent wealth killer. Now, what's really interesting about this slide is how it contrasts with the louder mistakes in the data, like panic selling in a downturn or chasing hot stocks out of FOMO. Out of all the mistakes highlighted in our source material, mistake number 4 is by far the most deceptive. It's silent. It is frankly incredibly boring, but man, is it devastating. It's the act of completely ignoring the little leaks in your financial boat. Just 1%, or maybe 2%. When you're setting up a brokerage account or looking at a mutual fund, a 1 or 2% management fee doesn't sound like a big deal, right? Your brain tells you, hey, I'm keeping 98% of my money. That's a great deal. But it's incredibly deceptive because we just aren't wired to understand how small percentages behave over long periods of time. Section 2. The cost of small fees. And this leads us right to the terrifying math of what happens when you ignore those tiny percentages. When you let an actively managed fund take a slice off the top every single year, regardless of whether the market goes up or down, you are essentially setting up a massive wealth transfer. You're just giving away the magic of compound interest. Let's put some hard numbers to this. If you start with a $100,000 portfolio growing at roughly 7% a year, a seemingly harmless 2% fee will literally cost you over $200,000 in lost returns over 30 years. Over a 30-year horizon, that harmless little fee acts as a relentless anchor, because you aren't just losing that 2% today, you're losing all the growth that 2% would have generated over the next 3 decades. That's money that absolutely should have been yours sitting in your account. But instead, it funded someone else's retirement.
Section 3. The drag of trading taxes. You see, fees are only one half of this silent monster. The other half is the secondary drag on your portfolio's engine, taxes. These are usually triggered by an investor's own restless behavior, specifically high-frequency trading. Taxes are basically like driving your portfolio with a parking brake firmly pulled up. You might be pressing the gas pedal, but you're creating so much unnecessary friction that you'll just never reach top speed. And this brilliantly illustrates the vicious cycles so many active investors fall into. First, they hear about a hot stock at a barbecue, and they chase it. Second, the stock bumps up, and they sell quickly to lock in that exciting gain. But then comes step 3. The tax man arrives, taking a significant cut of that short-term capital gain. And step 4 is the ultimate result. They have actively dragged down their long-term portfolio engine. By trying to be smart and nimble, they've actually penalized themselves and shrunk their compound growth.
Section 4. The low-cost solution. So how do we patch this massive 6-figure leak in our financial boat? Well, the good news is that the fix doesn't require you to be a mathematical genius or some Wall Street insider. It just requires simplicity. So the crucial point is that you must favor low-cost index funds and exchange-traded funds, or ETFs. These financial vehicles are designed to simply track the broader market rather than trying to beat it, which means their management fees are often a tiny fraction of a single percent, sometimes as low as 0.03%. By holding these broad funds and avoiding frequent trading, you drastically reduce your tax burden. You keep your money in the market, compounding efficiently, without constantly slicing off pieces for the government and fund managers. This quote right here from our source material is the ultimate antidote to the constant drag of fees and taxes. Think like a long-term owner, not a short-term trader. You really have to undergo a fundamental mindset shift. A short-term trader views the stock market as a casino, right? A place to dart in and out, constantly reacting to noise, paying fees, and generating tax bills. But a long-term owner views the stock market as a place to acquire fractional ownership of the greatest businesses in the world, and then simply sit back and let those businesses generate wealth for them over decades. Section 5. Mastering your investor mindset. Let's move to and see how this builds on the idea that discipline is far more valuable than genius in investing. Avoiding this $100,000 mistake actually has very little to do with being a stock market wizard. It is really all about mastering your own psychology. In the world of investing, emotional discipline is just far more valuable than raw intellectual genius. You don't need to outsmart the market. You really just need to outbehave the average investor. So here are your 4 pillars to do exactly that. First, automate your investments so you aren't relying on willpower or trying to time the market. Second, write down a plan and stick to it, especially when your caveman brain is screaming at you to panic. Third, force your perspective to focus on the decades, completely ignoring the day-to-day noise of the news cycle. And finally, remember that consistency will beat complex, expensive algorithms every single time. Which leaves us with this final, vital question. You now know that the biggest threat to your wealth isn't an external crash, but the silent internal bleed of fees, taxes, and emotional reactions. You hold the key to your own financial destiny. It's not about what the market does tomorrow, it's about what you choose to do with your strategy today. So, will you take the steps to patch the leaks, simplify your approach, and protect your portfolio from its own worst enemy? Think about that as you review your accounts this week. Thanks for joining me for this explainer, and keep learning.
All right, welcome to This Explainer. What if I told you that investors actually rarely lose $100,000 in one, spectacular, explosive bad bet? I mean, it's true. Those dramatic Hollywood-style financial wipeouts you hear about are actually pretty rare. Instead, people just kind of bleed out their wealth. They lose it slowly, quietly, through a handful of emotional, deeply ingrained psychological habits that literally just compound negatively over time.
So I want to ask you this right out of the gate, and I want you to really think about it for a second. What is the absolute biggest threat to your money? Go ahead, guess. Did you say a massive stock market crash? Or maybe sudden rampant inflation? Or perhaps a global recession? I mean, those are all scary, sure, but they actually aren't the real answer. Prepare yourself for a bit of a twist here.
Okay, let's dive into this. The biggest threat to your money is, well, it's you. More specifically, it's the quiet psychological traps that our own brains set up for us. You see, human beings are simply not naturally wired to be good investors. Our instincts, the exact same ones that kept us alive for thousands of years, are actually the very things that destroy wealth in modern financial markets. Today, we're going to break down the 5 most expensive psychological traps that investors fall into, and more importantly, how you can recognize them before they drain your hard-earned cash.
Mistake number 1. Trying to time the market. It is so incredibly tempting to think we can just magically buy at the absolute bottom and sell at the very top, but the reality is pretty stark. Missing just the 10 best trading days in the market over a multi-decade period can absolutely crush your lifetime returns. The stock market's biggest gains often happen in these sudden, completely unpredictable bursts, usually right after a period of really intense volatility. If you're just sitting on the sidelines trying to wait for that perfect time to get back in, well, it can easily cost you 6 figures in lost gains. No joke.
And this brilliantly illustrates that the solution is surprisingly simple, though, man, it requires immense patience. Time in the market is your actual superpower, not timing the market. You don't need a crystal ball, you literally just need a calendar. By staying invested through all the ups and downs, you basically guarantee that you are in the seat when those massive, unexpected up days actually happen.
Moving on to mistake number 2, panic selling in a downturn. This is where our caveman brains just completely take over.
When you log in and see a total sea of red in your portfolio, your brain just screams, danger! But here is the actual mechanism of wealth destruction. When you hit that sell button out of pure gut-wrenching fear, you completely transform what is merely a temporary paper loss into a permanent, locked-in reality. As long as you hold the asset, it still has the potential to recover, right? But the moment you sell, the loss is forever. The key to surviving this isn't trying to suppress your emotions, because that's basically impossible. The key is to have a cool-headed plan written down way before the panic even sets in. That logical plan is your absolute best defense when your emotions are begging you to jump ship.
All right, mistake number 3, chasing hot stocks and FOMO.
We all know this one. It's driven entirely by FOMO, the fear of missing out. That little voice in your head whispers, everyone's getting rich off that one hot stock, and you're not. It makes you feel inadequate, like you're the only single person missing the boat. But here's a golden rule for you. If you were hearing a can't-miss stock tip at a family barbecue, the party's already winding down. The explosive growth phase is over, and a correction is likely right around the corner. By the time the general crowd is rushing in, the smart money's already rushing out, and you just end up providing the exit liquidity for those early investors to cash out.
The fix here is strict discipline. You have to actively train yourself to tune out the social media noise. Seriously, the world's best investors are often the most boring people you will ever meet. They do not chase trends. Instead, you need to build a widely diversified portfolio that actually matches your personal, long-term financial goals rather than just throwing together a portfolio based on whatever ticker symbol happens to be trending online this week.
That brings us to mistake number 4, ignoring fees and taxes. Now, what's really interesting about this slide is that unlike panic selling, this mistake is totally silent and boring, which is exactly why it's so incredibly destructive. A 1 or 2% fee sounds completely harmless, right? I mean, it's just 2 pennies on the dollar. But thanks to the math of compound interest actually working against you this time, over a 30-year period on a decent-sized portfolio, that tiny little fee compounds until it eats up hundreds of thousands of dollars that rightfully should have been yours. High fees, especially when combined with frequent trading that triggers a bunch of capital gains taxes, act like a heavy anchor just dragging behind your wealth-building ship.
The solution to this one is incredibly straightforward. Be hyper-aware of your costs. You want to favor low-cost index funds and ETFs to prevent taxes and fees from dragging down your wealth. Keep your trading activity to an absolute minimum to avoid triggering taxable events. You really need to wire your brain to think like a long-term owner of a business, not some short-term trader trying to flip lottery tickets.
Okay, let's just take a breath here. Let's say you've actually done it. You avoided the market timing illusion. You held strong during a scary downturn, you totally ignored your uncle's hot stock tips at the BBQ, and you minimized your fees.
Because of your incredible discipline, you finally hit that magic milestone, your first $100,000. This is a massive achievement. You should absolutely celebrate it. But I need you to listen to me very carefully right now, because this exact moment, this milestone, is when you are at your absolute most vulnerable.
When you see that six-figure balance for the very first time, a super dangerous psychological shift happens. You look at your past few years of returns and you think to yourself, wow, I've cracked the code. Early success has a really funny way of tricking our brains. We end up confusing a broad, rising bull market with our own personal genius. We start to actually believe that we're market wizards who can do absolutely no wrong. And that introduces us to the real climax of our explainer, and quite frankly, the most dangerous trapdoor of all. Mistake number 5, overconfidence after a win. This is a mistake that sneaks up on you right after you've had some real success, getting a little too cocky. Once you hit a winning streak or cross that first 100K milestone, the ego just completely takes over. Suddenly, the boring diversified index funds that actually got you to that milestone feel totally beneath you. This is where people completely abandon their solid strategy. They start taking on way too much risk, trading options, leveraging bets, all because they feel invincible. Some people even stop contributing entirely because they think they've already won the game, and that the portfolio will just magically carry them to retirement on its own. Let me tell you, it is a spectacular recipe for sending that 100K plummeting right back down to zero.
So the crucial point is this. In the world of investing, discipline is almost always vastly more valuable than raw genius. The goal isn't to be the smartest person in the room, it's to be the most consistent. The investor who just sticks to a boring, steady plan for 30 years will almost always crush these so-called genius who hits a few lucky home runs, but constantly strikes out because they let their own ego get in the way.
Let's move to and see how this builds your actual defense. Mastering your wealth means setting up systems that literally protect you from yourself. You need to automate your investments so the money leaves your checking account before you can even think about touching it. Write down a plan and stick to it no matter what the news headlines are screaming today, and force your brain to focus on decades, not days. So I want to leave you with this final, somewhat provocative thought to ponder as you review your own portfolio today. Are you truly building sustainable wealth through discipline, or have you just been getting lucky in a rising market? Take a really hard look at your own emotional habits. If you found this explainer helpful in identifying some of those blind spots, make sure to hit that subscribe button for more deep dives into building wealth the right way. Thank you so much for joining me, and hey, stay disciplined out there. Welcome to this explainer. What if I told you that the absolute biggest threat to your money isn't a catastrophic stock market crash? We usually picture losing our wealth in one spectacular, dramatic bad bet, like a Wall Street movie scene gone completely wrong. But the reality is much quieter. Investors usually bleed out their wealth slowly, dollar by dollar, through a handful of quiet, psychological traps and emotional habits that silently compound over time. Today, we're going to break down the 5 most expensive behavioral traps that could easily be costing you $100,000 or more over your investing lifetime. More importantly, we're mapping out exactly how to stop them from draining your wealth.
So let's just dive right in and ask the most important question up front. When you look at your portfolio, when you think about your financial future, what is actually the biggest threat to your wealth? Take a second to really think about it. Is it the economy? Is it inflation? Maybe a bad CEO running a company you're invested in?
Nope, the villain isn't any of those things. The villain is you. Well, specifically, it's your own mind. It's those emotional, knee-jerk habits that we all possess as human beings. We are quite literally our portfolio's own worst enemy. So let's look at exactly how we self-sabotage.
Mistake number 1, trying to time the market.
This is the classic fool's errand. It is so incredibly tempting to look at a stock chart and think you can outsmart the system, like you can perfectly sell at the very peak and then magically swoop back in right at the absolute bottom. But here's where the math gets terrifying. Depending on your portfolio size, sitting on the sidelines because you are waiting for that perfect moment to buy back in can easily cost you 6 figures in gains, because missing just a handful of the market's best days, literally just the 10 best days over a couple of decades, will absolutely crush your long-term returns.
The fix is simple. Though it certainly isn't always easy to execute, you just have to stay invested. Trying to jump in and out is a losing game. Consistency beats guesswork every single time. Time in the market is your actual superpower, not timing the market.
Which brings us to mistake number 2, panic selling in a downturn.
This one is driven by pure gut-wrenching fear.
It happens the second the market gets rocky and your portfolio turns a scary shade of red. Market drops are a totally normal part of the ride, but knowing that doesn't make it any easier. Notice the contrast here. On one side, we have our primal caveman brain. When we see our balances drop, our instincts scream danger and tell us to jump ship. But hitting that sell button during a downturn is often the quickest way to lock in a permanent loss. On the other side, we have the solution, the logical plan. You need a cool-headed strategy written down beforehand to rely on when your emotions are screaming at you to bail out.
Next up, mistake number 3, chasing hot stocks and FOMO.
We've all felt the fear of missing out, right? That persistent little voice whispering that everyone else is getting rich off that one hot stock, and you're not. It creates this dangerous herd mentality where everyday investors buy in at an incredibly high price, right as the savvy early investors are already cashing out. Honestly, by the time you're hearing about a can't-miss investment at a family barbecue, the party is probably winding down. To fix this trap, step 1, ignore the noise. Tune out what's trending. Step 2, build a diversified portfolio that actually matches your personal, long-term goals.
Moving on to mistake number 4, ignoring fees and taxes.
Unlike panic selling, this mistake isn't driven by intense emotion. Instead, this trap is completely silent. It's boring, but man, is it incredibly destructive to your portfolio's engine. We're talking about ignoring the little fees and taxes that constantly nibble away at your returns behind the scenes. You might think a tiny management fee of 1 or 2% doesn't sound like a big deal. Sounds like a bargain, right? But watch how the math of compounding works against you. In year 1, that small fee is deducted, and you barely even notice it. Fast forward to year 15, and high fees, plus frequent trading that triggers taxable events, are acting as a constant drag on your growth. By year 30, on a decent-sized portfolio, that tiny 1 or 2% adds up to hundreds of thousands of dollars lost. That is money that should have been yours. The solution here involves a complete mindset shift. You need to think like a long-term owner, not a short-term trader. Frequent trading just triggers taxes and transaction costs. Do yourself a favor and stick to low-cost index funds and ETFs to keep that compounding interest working for you, not for a fund manager.
And finally, mistake number 5, overconfidence after a win.
This is a tricky one because it sneaks up on you right when you feel the safest. Maybe you cross your first 100K milestone, or you hit a great winning streak, and you get a little too cocky. It's so easy to suddenly think you've magically cracked the code of the stock market. People do foolish things here. They abandon their boring, solid strategy, they take on way too much risk, or they just stop contributing entirely. Remember, discipline is far more valuable than genius. The goal isn't to be the smartest person in the room, the goal is consistency.
Which leads us perfectly into mastering your investing psychology.
Look, avoiding these 5 mistakes has less to do with being a stock market wizard and everything to do with mastering your own psychology. The real secret to building wealth isn't some complex algorithm. It's discipline, patience, and consistency.
By automating your investments, sticking to your plan, and focusing on the decades, not the days, you can protect your portfolio from its own worst enemy, you. So, will you let your emotions cost you $100,000, or will you automate your discipline today? If you found this helpful, hit that subscribe button for more tips on building wealth the right way.